3 weeks ago, in Boston, Massachusetts, a 41-year-old biotech project manager named Andre Washington sat in his home office and pulled up his retirement account on a Tuesday night. Andre has been a disciplined saver for 17 years. He earns $164,000. His 401k has $487,000 in it. He thinks of himself as a responsible investor. He was reading an article on his lunch break that day about market concentration. The article mentioned that 10 specific companies now account for nearly 40% of the S&P 500. Andre hadn't really thought about that. His 401k is invested almost entirely in an S&P 500 index fund. That's supposed to be the safe, boring, diversified choice. So that night, Andre clicked into his fund's holdings breakdown. Just out of curiosity, what he saw stopped him. Out of his $487,000, approximately $185,000 of it was concentrated in just 10 individual stocks: Nvidia, Apple, Microsoft, Alphabet, Amazon, Meta, Tesla, Broadcom, JP Morgan, Berkshire Hathaway. 38% of his retirement money in 10 companies. He never picked any of them. He never wanted that level of concentration. He just bought what was marketed as the index. And the index quietly became something it wasn't 10 years ago. Andre stared at the screen for about 6 minutes. Then he opened a new browser tab and typed in, "Is the S&P 500 still diversified?" That single Tuesday night research session led Andre to a Goldman Sachs report he had not previously heard of. A report Goldman has been quietly distributing to its institutional clients since late 2025. A report that explains the single biggest portfolio risk facing American retirement savers in 2026. Almost no working professionals have heard about it. I'm Trish, and I read the policies and the reports nobody bothers to summarize. So Goldman's actual 2026 warning, what it says, what it doesn't say, and the 3 specific moves wealthy professionals are quietly making in response. You're going to know by the end of this video. Here's what makes this trap so quiet. If you have a 401k or IRA invested in an S&P 500 index fund, a total U.S. stock market fund, or even most diversified target date funds, a substantial portion of your retirement is concentrated in approximately 10 companies, most of them in one specific industry. According to Goldman Sachs' own 2026 Outlook research, the top 10 companies in the S&P 500 now account for approximately 40% of the index's market capitalization and approximately 30% of its earnings. 6 specific mega-cap technology firms, Nvidia, Apple, Microsoft, Alphabet, Amazon, and Meta, are projected to contribute nearly 50% of the entire S&P 500's earnings growth in 2026. Translation: when you buy the index, you are not buying 500 companies. You are buying about 10 companies, with a small side helping of 490 others. This was not always true. In 2010, the top 10 S&P 500 holdings accounted for about 19% of the index. Today, 40%. The concentration has doubled in 16 years, and almost no retail investor has noticed. Goldman's actual 2026 outlook is bullish on the S&P 500 overall. They expect the index to reach 7,600 by year-end. But buried in their research is a much more specific warning to their institutional clients. A warning about what happens to portfolios that are unknowingly over-concentrated in mega-cap tech if any of 3 specific risks materializes. The 3 risks: sustained energy price shocks, AI capital expenditure disappointment, regulatory action against any of the dominant firms. Any one of those events, if it played out, could trigger a 25 to 35% decline specifically in the mega-cap tech segment that drives the index. Investors who think they're diversified because they own the index would experience a much sharper portfolio decline than they expected. Today, I'm walking you through what Andre learned that Tuesday night. The actual concentration in your 401k. Why Goldman's institutional clients are quietly repositioning. And the 3 specific moves working professionals can make without sophisticated investment accounts to handle the risk. One thing before we go in. I'm not telling you to sell your index funds. I'm not telling you the market is about to crash. I'm not telling you to time the market or pick stocks. The opposite. What follows is about reinforcing the diversification principle that index investing was originally supposed to provide, but that the modern S&P 500 has quietly stopped providing because of how concentrated it has become. The standard advice for the past 30 years has been buy the index, hold for decades, don't try to outsmart the market. That advice was based on an index that was actually diversified across hundreds of companies, multiple sectors, and a wide range of business models. That index doesn't exist anymore. Today's S&P 500 is a concentrated bet on roughly 10 megacap companies, with the rest of the index providing modest diversification around that core. The advice still works if you supplement the index with the specific allocation moves that wealthy professionals are quietly making in 2026 to restore actual diversification. Now you're going to know how to do it yourself. Let me show you exactly what Andre saw on his screen that Tuesday night, because the concrete numbers matter. Andre's 401k, $487,000 total, allocated 90% to a Vanguard S&P 500 index fund and 10% to a US bond fund. When he clicked into the index fund's holdings, here's what he found. NVIDIA, about 7.4% of the fund. On Andre's $438,000 in that fund alone, that's roughly $32,400 in NVIDIA stock. Apple, about 6.8%, about $29,800 of Apple. Microsoft, about 6.5%, about $28,500. Alphabet, Google, about 4.2% across both share classes, about $18,400. Amazon, about 3.9%, about $17,100. Meta, about 2.6%, about $11,400. Tesla, about 1.9%, about $8,300. Broadcom, about 1.7%, about $7,500. JP Morgan, about 1.4%, about $6,100. Berkshire Hathaway, about 1.3%, about $5,700. Total in those 10 stocks, approximately $165,200. That's about 38% of his S&P 500 holding and about 34% of his entire retirement account. Andre had spent 17 years carefully not picking individual stocks. He was certain his portfolio was a broad bet on American business. It wasn't. It was, functionally, a concentrated bet on 6 big tech companies plus a few financial firms. The same is almost certainly true of your retirement account if you're invested in any S&P 500 index fund, total U.S. stock market fund, or target date fund. The specific percentages move slightly based on the day's prices. The pattern is the same. Goldman Sachs's 2026 institutional research lays out 3 specific scenarios where this concentration becomes painful. Scenario 1. Sustained energy price shocks pushing inflation back up. This forces the Fed to delay or reverse interest rate cuts. Tech valuations, which depend heavily on low interest rates to justify their high price-to-earnings multiples, compress. Goldman's bear case has the S&P 500 at 5,400 in this scenario, about 22% below the current level. Scenario 2. AI capital expenditure disappointment. The major tech firms have collectively spent or committed approximately $400 billion in AI infrastructure across 2024 to 2026. If the revenue from AI products doesn't materialize at the pace investors expect, those firms get repriced sharply. Because they dominate the index gets repriced with them. Scenario 3. Regulatory action. Antitrust enforcement against any of the dominant firms. New AI regulation that affects business models. International tax changes that impact the way these companies repatriate profits. Any of these creates concentrated risk. Goldman's institutional clients, the people managing pension funds, sovereign wealth funds, and family offices for the actually wealthy, are not panic selling. They are quietly rebalancing, reducing their concentration in mega-cap US tech, adding international equities, adding sectors that lagged in 2024 to 2025, like materials, utilities, and real estate, holding 5 to 10% in cash for opportunistic deployment if any of the three scenarios plays out. This is the move, not panic, not market timing. Boring rebalancing toward the actual diversification the index used to provide on its own. The three moves working professionals can make. Move 1. Add international equities. U.S. stocks currently make up about 65% of global market capitalization. The S&P 500 alone is approximately 50% of all stocks owned in the world. But U.S. stocks have been priced richly relative to international equities for several years. Forward price-to-earnings ratios on developed international markets are currently around 14 times. Emerging markets are around 12 times. The U.S. S&P 500 is around 22 times. Translation: international stocks are cheaper per dollar of earnings by a meaningful margin. They have historically performed strongly during periods when U.S. mega-cap concentration unwinds. Andre redirected 25% of his S&P 500 holding into the same two international funds the week after his discovery. His portfolio is now meaningfully more diversified than it was on Tuesday. Move 2. Add sector diversification away from mega-cap tech. Within the U.S. market, the easiest way to reduce mega-cap tech concentration is to shift a portion of your S&P 500 holding into an equal-weighted S&P 500 index fund. Equal-weighted means each of the 500 companies gets a 0.2% allocation, regardless of market cap. NVIDIA gets 0.2%. A small consumer products company you've never heard of also gets 0.2%. Same 500 companies. Different weighting. Dramatically less concentration in the top 10. Vanguard, Invesco, and several other firms offer equal-weighted S&P 500 funds. Expense ratios are slightly higher than market cap-weighted index funds, usually around 0.20%, but still very low. Move 3. Hold a meaningful cash buffer. This is the move most working professionals resist hardest. Holding cash feels lazy. Cash earns less than stocks over the long run. Why would you hold cash? 2 reasons. Reason 1. Cash is option value. If any of Goldman's 3 scenarios plays out and the market drops 25 to 35%, having 5 to 10% of your portfolio in cash means you have ammunition to buy at the bottom. The investors who recovered fastest from 2008 and 2020 were the ones who had cash to deploy when prices were cheap. Reason 2. Cash is insurance against having to sell stocks at the wrong time. If you lose your job, have a major health expense, or face any unexpected need for money during a market downturn, cash means you don't have to liquidate retirement assets at a 30% discount. Currently earning around 4.2%, Andre adjusted his target to 6% cash, building toward that gradually as he rebalances. In 2026, with high-yield savings accounts paying around 4% and short-term treasury yields around 4.2%, the opportunity cost of holding cash is the lowest it's been in years. The full Andre rebalance. Andre's portfolio at the start of his Tuesday night. 90% S&P 500 index, 10% US bonds. About 38% of the entire account effectively concentrated in 10 mega-cap stocks. Andre's portfolio after his 3-move rebalance completed within 10 days, 40% traditional S&P 500 index, 25% equal-weighted S&P 500 index, 20% international equities, split between developed and emerging, 9% US bonds, 6% high-yield cash. The total allocation to those 10 mega-cap stocks dropped from $165,000 to about $73,000. Still meaningful exposure to the AI and tech growth story. Far less catastrophic concentration if the three Goldman scenarios materialize. Total cost of the rebalance, approximately $0. All trades within his existing 401k. No tax consequences because everything happened inside a tax-advantaged account. Total time investment, about 90 minutes across 2 evenings to research the funds, log into the 401k portal, and execute the trades. 3 objections come up here. Let me handle them. Objection 1. But the S&P 500 has been the best-performing index in the world for decades. Why mess with it? It has. Because the past 15 years have been dominated by US mega-cap tech outperformance. The same concentration that drove those returns is the risk going forward. History shows clear patterns of leadership rotating between US large-cap, US small-cap, international developed, and emerging markets across roughly 7 to 10-year cycles. The current cycle of US mega-cap tech dominance has run for roughly 15 years, longer than any previous cycle in recorded market history. That doesn't mean it's about to end tomorrow. It does mean a portfolio entirely concentrated in the dominant theme is unusually exposed if leadership rotates. The wealthy don't bet entirely on the current trend. They diversify to capture the next one too. Objection 2. I don't know how to pick international funds or rebalance. This sounds complicated. It's not. The complexity people imagine isn't real. Vanguard Total International Stock Index Fund. Vanguard Total Bond Market Index Fund. Any equal-weighted S&P 500 fund your plan offers. If not Vanguard's, then iShares or Invesco usually have one available. Reallocate from your existing S&P 500 holding into these 3 additional funds in the percentages I mentioned. 25% equal-weighted, 20% international, 6 to 10% cash, rest in traditional S&P 500 and bonds. The whole rebalance, including research time, takes 60 to 90 minutes. Once. Then you let it run for years with annual rebalancing. Objection 3. What if I do this and the market keeps going up? I'll miss the gains. Possible. But the math of diversification is asymmetric in your favor. If the market keeps going up driven by mega-cap tech, your traditional S&P 500 holding, still 40% of your portfolio, captures most of that gain. You don't miss it. You just participate slightly less than someone fully concentrated. If the market goes through any of Goldman's 3 bear scenarios, your equal-weighted, international, and cash holdings dramatically cushion the blow. Your portfolio survives the downturn in much better shape than someone fully concentrated. Action steps. 3 steps. This week. None of them require sophisticated investment accounts. Step 1. Tonight. The concentration audit. Log into your 401k or IRA. Find your largest fund holding. Click into the fund's holdings or top holdings section. Look at the top 10. Add up their percentages. If the top 10 holdings represent more than 25% of the fund, you are more concentrated than you probably realized. The standard S&P 500 index fund will have around 38 to 40% in its top 10. Write down the number. Show it to yourself. 15 minutes tonight. Step 2. This weekend. The fund availability check. Go to your 401k plan's fund list. Look for 3 specific options: an international equity index fund, an equal-weighted US equity index fund, and a money market or short-term treasury cash option. Most plans have all 3. If you can't find one of them, call the plan administrator on Monday and ask. They will tell you what's available. Step 3. This month, the rebalance. Inside your 401k portal, redirect a portion of your existing U.S. equity allocation into the new funds. Suggested starting allocation, 40% traditional market cap weighted S&P 500 index, 25% equal weighted U.S. equity index, 20% international equity, developed plus emerging, 9% bonds, 6% cash. Adjust based on your age, time horizon, and risk tolerance. Younger investors with 30 plus years to retirement may carry less cash and bonds. Investors within 10 years of retirement may carry more. 3 steps: the audit, the check, the rebalance. Andre completed all 3 within 2 weeks. You can complete them this month. If this video helped you, or if you've ever assumed your S&P 500 index fund was protecting you from concentration risk, it actually isn't, do me one favor. Hit the subscribe button. New video on this channel every single day. Each one is a specific move that puts real money back in your pocket, same way this one just did. And here's what's coming tomorrow that affects every American working professional earning more than $100,000. There is a specific number, $184,500, that quietly went into effect this past January. Almost nobody is talking about it. It impacts your paycheck every 2 weeks if you earn above a certain threshold. The number has to do with how much of your income is subject to a specific federal tax, and how much that threshold has shifted over the past few years compared to where wages have actually grown. The result, for high earners, is a quietly expanding tax burden that almost no one warns you about, plus an additional surcharge for households crossing into a different threshold band that didn't exist 5 years ago. Tomorrow, I walk you through exactly what the $184,500 number means, why it's hitting more middle-class professionals every year, and the 3 specific moves to legally reduce your exposure. If you earn over $100,000, or you're heading that direction in the next few years, tomorrow's video is mandatory. I'm Trish. Talk to you then.